So, okay, we can just start our class and just start our class. Now, for our today's class is on what we call the introduction. Introduction to, can have it, yeah, introduction. Introduction. That's mainly what we'll start with on the part for introduction to taxation. May just think this one is not a little bit clear. This is the introduction to taxation. So introduction to taxation. So before we continue, now on introduction to taxation, on public finance and taxation, we'll be talking about two parts. We'll have the part for public finance, which is more of theoretical or theory, and then we'll be able to talk about the other parts of what we call the taxation. So in my concern today, in my concern today, and most probably on how we'll be able to do it, we're going to begin on that part of taxation. Then later on, we'll be able to get to the part of what? The part of public finance. So before we get to the part of what we call it, the part for the public finance, on the part of taxation, we will be able to talk about 6 topics that we'll be able to talk of. One, on what we call the introduction to the taxation, where we'll be able to know what we mean when we talk about taxes. We'll also be able to know what we call the classification of taxes. And then we'll again be able to know on the we'll talk of other things relating to what we call the resident or for someone to be called a resident person. In that case, we'll be able to understand more of that in that part. So on the part of taxation, we'll have the introduction to taxation. We talk about employment income, business income, value-added tax, investment allowances, custom duty and exercise duties. And then we'll also be able to talk about what we call the tax administration. Tax administration generally, that is more of theory. So that is what we'll be able to talk about. Let's just begin on the introduction to tax. When we talk about a tax, we normally say it is a compulsory contribution for a person to the government to meet the expenses incurred, the common interest of all without the reference of the special benefits conferred. So mainly we talking about a compulsory contribution. This is just out of the income of a person. And this is just to enable the government to meet its expense. And that is a common influence of all the individuals that earn income. So we have the characteristics of taxation, the characteristics of tax. One, as we've said, is a compulsory contribution, and this is to all from the people to the government. And anyone who refuses to pay tax is supposed to be punished. Remember, if you fail from payment of taxes and then you are relaxed, then in that case, you may be criminally liable. Now, number 2 characteristic is that it is a payment of the people to the government finance is functioned for benefits of all the citizens. So what we mean in this case, if we contribute taxes not only for our benefits, but it is for all the benefits of each and every citizen, either those who have not contributed and those who will contribute. We also have, it is not paid for a specific service rendered by the government. What we mean, there is nothing in exchange that you'll be able to get after you pay the taxes. There is nothing in exchange of what you pay as taxes, not out of the service that you'll be able to receive. So those are the three characteristics of taxation. We have what we call the revenue. Revenue is what we call the cash flows of the government from what we call the various sources, which include, we have the taxes, we have what we call the import, the fees levied on services provided by the government, like motor vehicle registration fee, import licensing fee, etc. You also have the fines charged on lawbreakers, state property fee like entry fees for game reserves or national parks. You also have the public debts that through treasury, disposal of public investment that is either on the sale of government shareholding in parastatals, the donor aids, that's through what we call the National Monetary Funds and World Bank. Then we also have the grants. That is what we call in the public revenues or the sources of revenue to the government. The sources of revenue to the government. Now, we have public expenditure, which on the other hand, this is just allocation of public revenues to various functions of the government, like for example, recruitment expenditures, which is a day-to-day operation of the government through payment of salaries and wages to the civil servants. Also, we may talk about the government investing on projects, and that is basically on what we call in the capital expenditure. Capital expenditure mainly may be in form of what we call the investment, the purchase of non-current assets, and also the disposal of non-current, no, the purchase of roads and so the building of roads and hospital and so forth. So capital expenditure, which include investment projects of government like building schools, roads, and hospitals. We have the functions of the government. Government world over are expected to carry out certain activities, and this is a part of services to the public. And the first service is what we call the administration, where it oversees the administration of the country by for instance, through in Kenyan scenarios, we have creation of provinces, district divisions, and locations, sub-locations, and so forth. That is mainly for the purpose of administration, for overseeing the administration of the country. We have also for protection. This is through security by ensuring security of its people from external aggression and internal security, which must always be provided. And this is why we are having what we call the armed forces and what we call the police. Social functions, in this case, is in facilitating social facilities, like for example, education, housing, health care, among others. We're talking about the social functions and also for development functions, which is just a duty to develop and maintain transport and communications network. We have agricultural systems, and we may also talk about what we call in the economic infrastructure. So those are the functions of our government. So they must make sure that, or they have to ensure, in this case, they have done those certain activities. That is for the interest of the public. Now, we also have what we call why government in this case levies taxes. Why government in this case rever or levy, from the word levy, taxes. Now, when you talk about tax levy, in this case, it's just a legal censure of your property to satisfy a tax debt. A legal censure of what we call in the property to certify a tax debt. So levies are different from what we call liens. When I'm talking about this lien. Let me just bring the board here. Now I'm talking about this lien here. A minute. So we're talking about this lien. Mainly clear. We are talking about this lien. This lien. Remember, there is what we call in a levy, and there is what we call a lien. So when I talk about levy, as just see, levy, this is just a legal censure, legal censure. A legal censure, and that is to satisfy a tax debt. But now when we talk about the, oh, this is, I'm confused. Let me just show you. I'm confused on this. This is the one that I'm talking about. So this is the one that I'm talking about. Minutes I do on something. So okay. Now this is what I'm talking about. We have it what we call a levy, and then we have what we call a lien. Now, when I talk about levy here, I've said this is just a legal censure. A legal censure. That is the legal censure of your property to satisfy your property. Now, generally, this is the legal censure of your property to satisfy a tax debt. But now, when we talk of levies, remember, as I've said, they are different from what we call in these liens. When I talk of lien, this is just a legal claim against property to secure payment of tax debt. Legal claim. Legal claim. That is what we mean when we talk about essential. So, I mean, when we talk about alien delivery. So, alien is just a legal claim against property, and this is just to secure what we call the payment of taxes, the payment of the tax debt, while levy actually takes property to satisfy what we call in the tax debt. We can just proceed now. So that is on what we mean, why government levies taxes. So when we talk of levy taxes, as I've said, is for example, in this case, if a government levy taxes, Manisha has explained there, it is essentially your property in order to satisfy is there. So what the question is this, or our what we want to talk about is what are why government in this case will levy taxes. So governments world over levy of taxes is not only to raise revenue but to do more other things. One, we have to raise revenue, that is raising revenue, protection needs policy. Now, when we talk of raising revenue, this is through what we call making sure that in this case each and every people will pay income, which in this case is an revenue to the government, which will help in financing or in the fund of the recurrent and capital expenditures. For protection needs policy, this just to protect what we call the local industries, and this through what we call the imposition of tariffs, the custom duties. Therefore, economic stability, that is, it helps through what we call the inflation and deflation, and also may control the expenditure patterns in the economy. Also, the government will levy taxes for distribution of wealth. That is to make sure that in this case, the poor, they are not taxed heavily as compared to what we call the rich. So in Malaysia, they will overtax rich, as in this case, the poor pays low taxes. Therefore, for allocation of resources, that is that they will use it for optimal allocation of resources in order of priority. Employment policy is to use the money to raise from taxes in order to create jobs for employees. So in other cases, what we mean in this case is just the importance of taxation. If I talk of here, you can just talk of it as stock benefits or importance of taxation. Those are also the importance of taxation. So we can proceed. Importance of taxation. So we can also get to types of taxes. Now, the types of taxation, in this case, we have four categories of taxes. One, we have what we call the income taxes. This is tax imposed on financial income generated by all entities within their jurisdiction. By law, business and individuals must file what we call the income tax return, and this is every year to determine whether they owe any taxes or are eligible for any tax refund. You mean here you will be determining what we call the tax payable, what you are supposed to pay to the government, or what the government in this case can refund to you. That is what mainly we mean in this case. Then income tax in this case is the key source of funds to the government, and it uses to fund its activities and to serve the public. And the main income taxes here, we have the corporate taxes, that is from companies. We also have pay, that is pay as you want from individual. We also have the capital gain tax, that is out of what we call The capital gain tax is out of disposal of purchases of non-current assets. It is just out of what we call the disposal and the disposal or the disposal or the purchase of non-current assets. Now, we also have what we call the advance tax. Advance tax mean what we mean here on advance tax. We mean the taxes. You can clear that. When we talk about the advance tax here, is the tax paid in advance before a public service vehicle or what we call commercial vehicle is licensed at the rates applicable. That is what we call the advance tax. Again, we have what we call the presumptive tax. This is a tax that is normally based on the accounting records. It is normally payable by a resident whose turnover from business does not exceed 5 million during the year of income. That is what we call the presumptive tax. The tax payable by resident person whose turnover from the business does not exceed Kenya shillings 5 million. We also have what we call the fringe benefit tax. The fringe benefit tax. Now, fringe benefit tax is a tax that is normally imposed. It is normally imposed on employees receiving extra benefit in addition to their wages. This is what we mean. Like, for example, if they are selling goods, the employee will be, the good will be sold to the employee at a price that is below the market price. So the benefits from there, which in this case is what we call in the fringe benefits, we talk of them as non-taxable. We also have what we call the withholding tax. Withholding tax, generally, this is just the tax at source. The tax, that is just the tax at source. The tax at source. That is what we mean when we talk about that. So that is the type number one. The second type is what we call the consumption tax. This is just what we call the consumptive or what we call the spending tax. The tax that is levied on consumption, spending on goods and services. Then we have the tax of duties, mainly is tax imposed on imports and what? Export. That is what we call the custom duty. We also have what we call other taxes, fees and levy, where we have, like, for example, entertainment, petroleum development funds. This is not now normally what is used to subsidize the petroleum in Kenya. We have import declaration fund. We have foreign motor vehicle inspection fee. We also have the road maintenance levy, road transitory levy, aviation revenues, revenue reserves, and we have the KEBS levy, Kenya Bureau of Standards levy. Now we have very common question, the principles of what we call the taxation, the principle of taxation. In other cases, we talk of them as the canons of taxation, principle or the canons of taxation. Now, the principle or the canons of taxation. Now, you've said that you didn't get the advance tax. Now, I've seen when we talk about the advance tax, and I talk about advance tax is tax that is paid in advance before a public service vehicle or a commercial vehicle is licensed at the rates applicable. That is mainly what we mean when we talk about tax. Or you may talk of it as an amount of income tax that is paid much in advance rather than the lump sum payment at the year end. We may talk of it as earned tax or adverse tax. Now we have the principles of or the canons of taxation. Principle or the canons of taxation. Now we have number one, we call it the principle of equality. Principle of equality. Principle of equality. Now, minute principle of equality. Now, when we talk about principle of equality, principles of equality, that is just out of the principles of taxation, or what we call the canons. This is just the canons of taxation. Canons of taxation. Canons. They were established by a person we call them. This is by Adam Smith. This is by Adam Smith. Yeah, they were established by someone we call the Adam Smith. That is the person who advocated for all those principles, the principles of taxation, by the name Adams, the Adams Smith, the Adams Smith. Now, and this mainly on the payments of taxes, the payments of taxes. So the first canon of taxation is what we've been able to talk about here, the canon of equity. Canon of equality. So in this case, it requires that all the taxes or a good tax system should be based on the ability to pay the tax, and that is by the people. That is what in this case the principle states, that a good tax system should be based on the ability for an individual to pay taxes. Number two is certainty. This one means that the time and amount and method of payment should be clear and certain to the taxpayers so that they can adjust his income and expenditures accordingly. So what this principle is trying to do, the principle of certainty, is trying to remove what we call the uncertainties in the payment of taxes and make sure that the government in this case will run or function smoothly. Then there is the principle of convenience. When we talk about the principle of convenience, is at the time at which the time at on this one requires that the tax should be collected in such a way that is convenient to the taxpayer. What we mean in this case is a time that the taxpayer is very convenient to be able to pay the oath for that taxes. Then we have what we call the canon of economy. Now, on the canon of economy, in this case, this one says that there must be minimum amount that should be paid to the taxes. And again, there is also what is supposed to remain on the pockets of the taxpayer. So means that at the end of it, the taxpayer will not pay all the money that is out of the income and pay taxes on all the income, but he has to remain with some amount to spend for his well-being in that part. Then we have the principle of what we call productivity. This tax system should be productive enough. It should ensure that there is sufficient revenue to the government, and it should also ensure that they encourage productivity by encouraging people to work, save, and do what? Invest. Then we have what we call the principle of elasticity. We mean the taxes in this case should be flexible. We mean in this case they should increase or decrease depending on the need that the country in this case will be having. Sawa sawa. So as if I are very constant. Then diversity. Tax system of a country should be diversified. In this case, the burden of tax should not be or be distributed widely on entirely on the people, but can be decentralized so that everyone should pay as per his ability. We also mean that there is principle of simplicity, where this one says that the tax system should be simple, easy, and understandable to the common man. So if the tax system in this case is complex and big, mean that the taxpayer cannot be able to do estimate his tax liability, and this one may cause what we call irregularities, or what mainly we call the tax evasion. What we call the tax evasion. Tax evasion. Now we proceed. The other one is the principle of expediency, whereby a tax should be levied after considering all favorable and unfavorable factors from different angles, such as economic, political, and what we call the social. There is also principle of coordination. This is in federal setup, like for example, Ethiopia, federal and state government levy taxes. Mean this is there should be proper coordination between taxes towards the different various authorities. We're talking about the taxes in Kenya and taxes in what we call taxes in other countries. Now, the other one, number 11, we have what we call the principle of neutrality. This is a principle that stresses that the tax system should not be biased. Should not be. Should not be. This one requires that the tax system should not be biased. The tax system should not be biased. Unapata iko na kipendeleo. So that is on that part. So when you take from the past paper, mainly on that part of that question, let me just share you to be able to see what I mean. A minute. We can have the from the past paper. This is very common question. It's a very common question. It's a very common question. Yeah, the question. Okay. Okay. So already this one for this is in the sitting of this from the sitting of November 2019. We've been able to know the sources of revenue. Mainly the sources of revenue for government. Remember, county government is also part of the revenue. So that is on the part that we see why government revenue, not why the sources of government revenue. You know the sources of government revenue, by the way, is what we were talking about the fees there, donations, all the taxes. Those are the sources of government revenue. What we began with, where we were talking about the public revenues, and we talked about the examples. Those are the sources of government revenue. Sources of government revenue. So I'm looking for the questions. I know there's very many, mostly on the canons of taxations. In other questions, they will talk of it as the principles of taxation, but mainly is what we call the canons of taxation, canons of taxation. Um, Once I just identify the question, I will be able to share. I will just be able to share the question because I'm unable to see the question. So let's just proceed. Let's just proceed. Now, we can now get to what we call the classification of taxes. Now, before that, there is what we call the single tax system and what we call the multiple tax systems. A single tax system and multiple tax systems. Now, generally, these are just the examples of tax systems. And when we talk about single tax system, this one means only one kind of tax. A single tax system denotes the only tax exclusive tax on one class of deeds. And for example, we'll talk about what we call the under the classification. There is what we call the proportional, progressive, and regressive. Those are single tax system and are normally pay a single fixed amount. Then we have the advantages here. One is simplicity. The levy and collection expenses are very easy. Of the revenue would be very easy. Levy and collection of taxes can be good if concerned and is clearly selected. We also have the demerits of the single tax systems, where the great defect of the tax system is that from the revenue point of view, tax yield may not be sufficient for the government. Yield of any single tax does not increase rapidly, and as the yield from multiple taxes can do. We have increase in the rate of tax alone cannot increase the revenue. Now, multiple tax systems mainly on what we call the multiple tax. Multiple tax system is now this one will be in more than one kind of tax. So on multiple tax system, on the multiple tax system, just a tax that is normally levied in various items, like we can talk of the VAT, that is a multiple taxes. VAT, because in this case you can have so many varieties of items that are being taxed. The main purpose in this case is just for the growth, equitable distribution of income and wealth, and also for economic stabilization and so forth. Those are what we call the multiple tax system. In other questions, you may be asked to talk about the advantages of multiple tax systems, the advantages of multiple tax systems. You know the advantages of multiple tax systems. One is that they are efficient. Mainly, we are just talking about the disadvantages of these. They will be efficient. Here, they will also increase the revenue of the government. Again, also, they are more flexible than the single tax system. So, those are the advantages of the multiple tax system. I hope you have indicated that. I'm talking about multiple, the multiple tax system. That is the one that we are talking about. One of the advantages I've seen is the mission in changing the tendencies of frequent tax evasion, but due to increasing the tax revenue of the government. And the number three, say, is more flexible. What we call it the single tax system. More flexible and single tax system. Now, we have classification of taxes. Now, on classification of taxes, we normally classify taxes in three ways. We classify taxes in accordance with what we call effect. And we also classify taxes in accordance with what we call the tax rate. And we also classify taxes according to what we call the tax base. So let's just begin with the classification based on what we call the effect. And before we talk about the effect, there is what we call the tax incidence, and there is what we call the burden, tax incidence, and what we call the tax burden. Now, tax incidence, this refers to the person who bears money burden of tax or payment. Generally, the person who pays the tax. Burden is a person to whom tax is involved. Like, for example, the person who has the responsibility of accounting for the tax. Now, under the effect, we categorize taxes into two. We have the direct taxes and we have the indirect tax. Direct taxes are they are taxes who both the tax incidence and the impact is on the same person. We are talking about the cases of what we call the pay as you earn, payee. We're talking about pay as you earn, pay as you earn, pay as you earn, payee. Yes, we're talking about payee. That is a direct tax, mainly, or that is where we're talking about the income tax, corporation tax. Income tax is what is giving us the capital gain tax, inheritance tax. That is what we call the direct tax. The tax incident, that is the person who bears the burden of tax, and the tax burden is on the same person. The tax, the person who tax is involved. We have the advantages. Number one, it will achieve what we call equality. Because remember, it will be paid depending on the ability. Ndio pay ulipo hivyo. Paternity is paid. It usually paid after the end of the month. This is mainly when you have earned your income. So meaning that there is certainty. Also, there is what we call economical, and this is just on the cost of population. What we mean on this is just on the principle of economy, whereby the principle of economy, there is something that I have not told you. This one requires you that the collection of the cost collection of tax should not be more than the, the revenue, the tax revenue collection. So this one will achieve that. Find that the cost of revenue is low since it is deducted and remitted by the government at the source. Is also elastic, there is also simplicity, and there is what we call the civic consciousness. So we mean the most of the public members in details do understand how to pay the taxes to the government, and that is mainly on what we call in the world the pay as you earn, pay. Now, disadvantages. This will discourage investment and savings, the lower coverage, it discourages production, prone to evasion, because some employees may give what we call the false statement to reduce their own tax liability. And in other cases, you may talk of it being inconvenient. Pay, person pays such taxes must undergo the process of registration with may with many formalities, and taxpayers may not take their time and resources to do that. Number two, we have what we call the incidents. This is now where the incidents and impact fall different persons. In this case, we are talking about what we call the VAT, mostly on VAT, value added tax, VAT. So it is they fall on different person. The other one they follow the same person. I'm talking about this, the import duty, the export duty, etc. Merits one, there is wide coverage, is elastic, more economical, diversity, there is less evasion. There is no way you can evade VAT. Lazima uende ununue your good and those ones. Uncertainty, we have regressive. Napata the rich and the poor are paid equal rates. Because sasa ukienda ununue goods, you not buy it different from how the rich will be able to buy it. In other cases, we may talk of it being an economical to collect for the cost of duties, especially. Then we have the government, because the government in this case is employing all officers in all points of entry to help for that purpose. Now we have the classifications of based on the rates of taxes. There are four of them. We have what we call proportional. We have progressive, regressive, and what we call the what? The digressive. For progressive, this is where the marginal rate of taxes rises with income. So if your income increases, the tax will also do what? Increase. At your own time, you look at those two, the advantages, and you also consider the what? The disadvantages. We also have proportional taxes. This is where a tax which is proportional when the same rate of tax is applied to all taxpayers, irrespective of their income level. For example, we are talking about the what? So this one, it will be paid at the same rate. Now, like in corporate companies, currently they are paying us 30 what? 30%. This 30%. That is what we call it proportional taxes. So this 30% is paid to all, and this is irrespective of what? Is irrespective of the amount that they earn. Now we also have what we call the advantages. This one, there are only two. One is that it is uniformly applicable. That is uniformity. That is one, uniformly applicable. Number two, it leaves the relative economic status of the taxpayer unchanged. And number three, it is simple in the generally mean it is simple in what we call neutrality. Generally simple in what we call the neutrality. When I talk of neutrality, in this case, you mean cannot be biased. In this case, it cannot be biased. We can proceed. So you'll also look at the disadvantages and also look at the what? You'll check at the disadvantages and advantages of the same, this one. Now, regressive taxes, they are taxes, one where the rate of tax falls as income increases. So as income is increasing, the taxes is falling. So we mean that the poorer are the ones that will be charged more at the sacrifice or their greater sacrifice than the what? The rich. The aggressive now, this one is whereby as the income goes, income earners will contribute higher income as compared to the low income earners. So meaning that here the rich is the one will be taxed more. Now we have classification of taxes based on what we call the tax base. And the tax base in this case is the objective by which the tax is calculated. In this case, according to base, we'll have the income tax. This is the tax base in the income of an individual. Corporate tax, the tax base is in the profit of the body corporate. And the third one is custom duty, the tax base in the value of imported goods. And we have also the exercise duty, tax base in the value of locally manufactured goods. Now, the other thing is what we call the tax shifting. This is whereby you are transferring the tax burden from one person to another. Generally, we mean where the producer will transfer the tax burden to the consumer. That is what we call the tax shifting. So there may be what we call the forward shifting, and there is what we call the backward shifting. When I talk of forward shifting, it is the tax that is shifted from seller to consumer. But now when we talk about the backward shifting, this one will take place when the consumer do not purchase the commodities and the price increases in prices. So the sellers are then forced to cut prices and bear what we call the tax burden. So we mean in this case, the tax burden is on the consumer, but on the other side, the tax burden will be on what? The seller. We have the factors determining the tax shifting. This is a very common question. One is the elasticity of demand and supply. That is either the increase in price or decrease in prices. And more elasticity lowers the incidence of the same. This is the higher the incident will be on supply. We are talking about number two on the part of the nature of the market is mainly on what we call the oligopoly market. Oligopoly market, this is where we have few farms, but with many small ones. So sellers and many buyers there. The tax shifting to buyers is high, since few sellers can team up to determine the market price of the commodity. They also have the government policy on pricing, generally where they introduce what we call the price control. Night of price control is just the art of government to set or to boss prices. These prices, we normally call them the flat prices. You also have the geographical locations. If taxes are imposed in certain regions, it may be hard to shift them to consumers because the consumer will move to regions with low taxes. The nature of tax, we're talking of whether the indirect or the direct taxes on top of the rate of tax and time available for the adjustment. The time available for adjustment. Again, we have what we call the tax evasion and what we call the tax avoidance. Now, when we talk of tax evasion, is the illegal evasion of taxes by individual, corporation, or what we call the trust. Generally, this is deliberately misrepresenting the true state of the affairs to the tax authorities, and mainly purpose is to reduce their tax liability. Generally, we are calling it the dishonest reporting. This is a fraudulent action on the part of the taxpayer. This is a violation of civil or criminal provision of the tax laws. And this one, the principle, this one defines that tax evasion implies that activities involving an element of deceit, misrepresentation of facts, falsification of accounts, including what we call the downright fraud. That tax crime is deliberate attempt to illegally obtain benefits through violation of tax laws. So our time you will be able to see all those many forms which will lead or will in this case lead to what we call the domestic tax crime, like non-filing of returns, failure to register a tax entity, failure to furnish tax returns, failure to pay taxes, fail to keep records, fail to remit records, and so forth. Still, again, you also need to know the causes of for tax evasion. Is what we call the multiplicity of the tax laws. They are also complicated. High rates of taxation, inadequate information as the sources of tax revenue, investment in real property, ineffective tax enforcement, deterioration of the moral standards. Remedies of tax evasion, where you can thoroughly overhauling your tax laws reduction of the tax rates, maintenance of proper accounts, etc. Now we have what we call the taxable capacity. This is also another one. So you can talk of what we call the tightening of tax enforcement. Now we have the taxable capacity, the taxable capacity. Now, taxable capacity mainly, this is the maximum amount. That maximum amount can be deducted from country's income consistent with the maintenance of the income for years to come. The taxable capacity is normally in two senses. We have what we call the absolute capital taxable capacity, which in this case indicates the amount of money or the proportion of national income that can be taken away by the government from people in form of taxes without producing unfavorable effects. And then we have what we call the relative tax capacity, where in this case it normally refers to the proportion in which two or more communities can contribute in the form of taxes to meet some common expenditure. Now we have what we call the taxable capacity. Oh, this one is just on repetition. The factors that influence taxable capacity. That is a very common question. One is the number of inhabitants, or the people, the capacity of people in a given society. The other one is distribution of income, the method of taxation, purposes of taxation, psychology of the taxpayer, stability of income, then inflation. You also have on fiscal policies, but mainly you need to know on the what we call the objectives. This is a very common, so this I will give you as an assignment on what we call the objectives on assignment. Assignment on assignment. Assignment. Assignment, you need to talk of you need to know the objectives of physical policies. Physical policies. When I talk about physical policies, just the use of government spending program and government revenue to produce desirable effects and avoid undesirable effect on national income, production, and employment. Now, these are part of the questions that are set on those particular areas. The part of questions that are set in particular those areas that we've been able to cover, and we can go just check on them very fast. The questions that are set on that topic. And that one I had already indicated. Now this one, you will do this as an assignment. This is in the sitting of September 2021, question number 4A. 5A, sorry, September 2021, question 5A. Just go through it at your own time. And you also need to have some answers of the same. You'll also check on we also have on I think every 2021 was there. This one. Ways through which taxpayers engage in tax evasion. You'll do that is on December 2021. December 2021, question number 5A. December 2021, question 5A. The other one is this one. This was there in last sitting. The factors that determine the taxable, that is April 2022. And also this one, reasons for failure to achieve tax revenue targets. This one. You also have to check on that. Is on August, said August, not August, but April 2022. That was the previous sitting. So those are the, I think those are the part of the questions. And those are part of the questions. Yes. So in our next class, we just talk about the second topic, where we talk of what we call the residence of a person. Mainly, that is on what we call the employment income. Employment income on this part. This is what we'll be able to talk about, residence of a person on that part. So that is what we'll be able to talk about in our next class. But make sure that first we go through them, because this one will help us mainly on taxation of employment. So any question?